Good evening, everyone. We are Group 6. Tonight we will be presenting the Empire Company Limited, the Oshawa Group Limited proposal case. My name is Gorpravaz.
I am Parmveer.
I'm Jennifer.
Amangat.
Hi, I'm Kabir.
I'm Prav.
This case itself is about the Canadian food industry, and so tonight's presentation we will start off by talking about the industry itself, the two companies involved, as well as their competitors, and then we will go on and cover the evaluation, followed by the recommendation and the conclusion.
To start off about the industry, there are three primary activities: retailing a general line of food, such as fruits, vegetable, and bakery goods. Second, retailing health and beauty products, such as pharmaceutical drugs and cosmetics. And third being retailing alcoholic and non-alcoholic beverages. There are 8 sectors that make up this industry, and here's the list. With dairy, egg, fish, and meat products covering the largest sector of 27.6%, and the second largest sector being other foods and non-alcoholic beverages of 18%. Key success factors. So some of the key success factors to this industry is being able to locate close to key markets so they can maximize their exposure to high populated areas such as shopping malls. Another key factor is also having a well-managed inventory system so that it minimizes unnecessary stock buildup, and having a loyal customer base because this industry relies on competitive pricing to gain their market shares. Also, by offering the latest technology and a wide range of products, will attract different consumer segments.
As of right now, the current Canadian grocery industry is experiencing some hardship as sales have not been moving for the past 2 years. During 2012, sales only grew by 1.1% over a period of a year, while in 2011, sales only grew by 1%. These values are not what grocers anticipated, as they had expected higher yields as industry average was around 3%. When looking back at the last 2 years, we can see that sales were at its lowest levels of growth within that decade. Numbers like these were not seen since 1995 when sales growth was at 0.8%. There were a number of factors that attributed for the slow pace in growth for 2012. To add, many grocery products were bought at non-traditional food retailers such as Walmart, Costco, and drugstores. Walmart in particular opened more stores last year than ever before. Today, more than half the Walmarts in Canada are supercenters, carrying all food items of a traditional supermarket. Another factor that attributed to the slow-paced growth is the rise of South Asian and Chinese ethnic grocery stores. To add, the 2008 recession saw many consumers beginning to penny pinch when purchasing goods. Due to this, Canadians are looking for a deal or promotional prices while they are shopping at discount stores. 75% of Canadians say they are only buying on sale. 71% are using coupons, while 66% are stocking up when products are on sale. And 62% are seeking out stores with lower prices. Canadians are beginning to make grocery purchases at a rate of 67%, where 71% of users use coupons. Other consumers are stocking up on products while they're on sale, which is around 66%. Lastly, 62% of consumers are looking for stores that have lower prices. It is clear to see that discount stores make up more than 40% of all grocery goods bought in Canada.
We will not cover the Oshawa Group. Oshawa Group Limited was founded in 1951 by founder Ray Wolf. It was a food retail, wholesale, and distribution company. Through 47 years of business, Oshawa Group Limited has grown and expanded itself through products and geographical locations. In the 1960s, Oshawa Group Limited acquired various retail chains and stores. Some of those were the Dominion, Food Town, Price Chopper, Boots Drugstore, which eventually became Farmer Plus, which became Yaxel. Outside of retailing, Oshawa Group acquired various companies and real estate as well. Oshawa Group Limited offered 845 locations across Canada. Oshawa Group Limited is a family-owned corporation, and all the voting shares are owned by the 5 Wolf family members. The entire operations were sold in 1998 to Sobeys, and the Oshawa name disappeared from Canadian retailing.
Now we will cover some of the competitors at that time. We'll begin with Empire. Empire was founded in 1907 when J.W. Sobey opened a butcher shop in Stellarton, Nova Scotia. So the main thrust of the company was the support and operations of the Sobeys retail grocery business. Empire earned $88 million on revenues of $3.3 billion in the fiscal year of 1998. In 1998, Sobeys became the second largest grocer in the country after purchasing the Oshawa Group. Owners of the IGA franchised across Canada, along with several regional chains in Ontario, in addition to various food service and wholesale companies. Now the second competitor we will talk about is Canada Safeway. Canada Safeway was based in Calgary and was a private, wholly owned subsidiary of Safeway Incorporation of California. With having labor disputes in 1996, Canada Safeway remained a dominant grocery store chain in Western Canada. Income before taxes, extraordinary items from Canadian operations was US $97.9 million on revenues of US $3.4 billion. They have enough financial capacity to compete for the bid on Oshawa, yet they did not want to do it, since they did not want the competitive Ontario market and or expand further east. Lastly, I will talk about Loblaws. Loblaws was founded in 1919 by Theodore Loblaw and John Milton Cook. It is Canada's largest food retailer with 20% national market and a current market share of 30.4%, has various locations throughout Eastern and Western Canada operating under various banners. In 1997, Loblaws earned $213 million on revenue of $11 billion. It is the only company to compete on a national basis and is seen as the greatest competitive risk for a rival bid for Oshawa. The only mitigating factor was the acquisition would raise the risk of scrutiny from the Canadian Competition Bureau.
The next competitor that we're looking into is called Overweightia Food Group, which is based in Langley, BC. It is currently owned by the Jim Pattison Group. It employs 15,000 employees as of August 2015. It was founded in 1915 by Robert C. Kidd in New Westminster, BC. Robert C. Kidd had developed various innovative merchandising techniques to attract customers to his stores, including odd penny pricing and selling 18 ounces of tea for the price of a pound. Store banners that fall under his company are Save on Foods, Overweightia Foods, Urban Fare, and Cooper Foods. Overweightia can be seen to give a rival potential bid. As Oshawa only has a small presence in BC, the acquisition would provide national exposure for Overweightia. Another company that we looked into was called Metro Richelieu. It was founded in 1947. It is the only major Canadian food distribution company to have its head office in Quebec. It's the largest food retailer within Quebec, and it operates under Metro Supermarkets, Super C Discount, and runs wholesale distribution businesses there. In 1997, net income earned was $66 million and revenues earned were $3.4 billion. Metro Richelieu was seen as a potential rival for the acquisition of Oshawa. If Metro Richelieu was successful, it would be the largest vendor in Quebec and have a national scope.
The next company is the Great Atlantic and Pacific Company of Canada Limited. It's a private company that is wholly owned subsidiary of the Great Atlantic and Pacific Tea Company of New Jersey. Total net income operating in Canada was $895,000 US and revenue was $1.5 billion US. AMP is not seen as a potential rival bidder for Oshawa. In addition, the parent company has never expressed any interest in expanding their Canadian operations. Alright, so now we're going to cover the valuation and different aspects among them. Firstly, we're going to cover common shares and their different classes. Common stock usually enables an individual to vote for every share that they own, but that's not always the case because there are different classes among common shares, and that varies on how many votes are attached to them. Before going over the evaluation of Oshawa, I'm going to go over some of the assumptions that were made. The sales in the current year were $7 billion. The growth rate for the next 5 years is considered to be 6% constant. This is calculated by looking at the historical sales growth rates and the trends and making an informed prediction based on the historical and future trends in the industry. The next assumption is the EBITDA margin of 2.6%, which is a measure of a company's EBITDA as a percentage of its total revenue. This gives more insight into a company because it minimizes the non-operating effects that are unique to every company, thus giving investors the ability to focus on operating profitability as a single measure of performance. The next assumption is of depreciation, which will stay constant or a forecast horizon as 1% of sales, regardless of any new acquisitions or disposals of capital assets. Then there's working capital change, which is a change in current assets minus current liabilities, and this will stay constant at a rate of 4% of sales. Next, our model is going to assume that capital expenditure in year 1 is going to equal 2% of sales, and year 2 to 5 it will be incremental rate of negative 0.25, eventually decreasing down to 1% in year 5. Our tax rate assumption is 40.1%, but we are going to round it down to 40% and keep it constant for the future horizon. Then there is the risk-free rate, which is 5.8%. This is based off a 10-year government bond rate. Then there's debt premium, which is assumed to be 4.08%, which is based on a 40% tax rate. Lastly, beta, which measures the company's volatility. Ours is 0.77, and below 1 means less volatile. Market risk premium is going to be 5%. Generally accepted principles leaves a rate between 5 to 6%, as it's the expected differential return of the market over treasury bonds. Current capital structure of Oshawa includes 12.4% of debt. Since it's not clear if this is optimal, long-term debt will be 20%, thus making equity 80%. Lastly, the cost of equity is going to be 9.65%. Based on this, WACC is calculated to be 8.54%. We are going to assume that in our model, long-term growth rate of the company is going to be 5% in perpetuity. Without this long-term growth rate, we assume the company shuts down after a 5-year period.
So next I'll be explaining the valuation model that we use to evaluate the company. We use a discounted cash flow model that I'll be going over. Now it can be hard to understand how stock analysts come up with fair values for companies or why target prices estimate vary so widely. The answer here often lies in how they use their valuation models known as a discounted cash flow. In simple terms, discounted cash flow tries to work out the value of a company today based on projections on how much money it's going to make in the future. It is described as discounted cash flow because cash in the future is obviously worth less than cash today. Now, forecasting a company's revenue is arguably the most important assumption one can make about its future cash flows. However, it can also be the most difficult assumption to make. We needed to think carefully about the company, the industry, and what it could look like and evolve in the future. Now that we have explained our assumptions and have determined our revenue growth for our forecast period, we now need to estimate the free cash flows produced over our forecast horizon. Now, discounted cash flow valuation is to find the sum of the future cash flows of the business and discount it back to a present value. Now, to get free cash flows, which is the actual amount of cash that a company has left from its operations after deducting operating costs, taxes, net investment, and the working capital, we need to begin with net income. This is essentially cash that could be used to pursue opportunities that enhance shareholder values. Examples would be paying dividends to investors or doing share buybacks. When we can get net income by taking EBIT minus tax, which you can see amounts to 71.2 in 1999, numbers being in millions. Now that we know net income for the year, we need to add back depreciation and amortization expense, which amounted to 74.2 in 1999, since these amounts are non-monetary expenses. Capital expenditures are considered essentially an outflow of funds required to maintain a company's competitiveness and efficiency, and knowing that based on our assumptions in 1999, this will amount to 2% of sales, followed by in the following years 0.25% reduction, we need to minus out 148.4. The next step is to account for change in working capital, which is essentially current assets minus current liabilities from prior year's change. To illustrate, current assets are accounts receivable, which is basically money yet not received. So it's only when accounts receivable decreases that cash flows increase. So if it's positive, meaning there's more assets and liabilities, you would minus. Based on our assumptions, we know that working capital will change by 4% as sales increase or decrease. Sales increase throughout our discount cash flow model, so 4% of sales in 1999 would amount to a change in working capital of 16.8, which needs to be minused out. As you can see, we can now calculate free cash flows, which amounted to negative 19.8 in 1999. Now, having estimated free cash flows produced over the forecast period, we now need to come up with a reasonable idea of the value of the company's cash flows after this period. Now, a key thing to remember here is if we didn't include the value of the long-term future cash flows growth rate, which was 5% based on our assumptions we know, we would have to assume that the company stopped operating at the end of our 5-year forecast period, which is obviously not acceptable. Now you would ask, how would we do this? Now it's hard enough to forecast future cash flows over a 5-year period reliably, never mind the entire future of a company. As to make this task a lot easier, we use a terminal value approach, which involves making some assumptions about long-term cash flows, growth, and perpetuity. A key thing I want to point out before we continue is that the terminal value formula, as seen on the screen, rests on the big assumption that cash flows of the last projected year will be stabilized and continue to grow at the same rate forever, which is 5%. Now that we know how to calculate and what terminal value means and does, as seen, this amounted to 2040.6, obviously numbers being in millions. Now, having projected the company's free cash flows over our 5-year forecast horizon, we need to figure out what these cash flows are currently worth today. So what we needed to do next was to come up with a reasonable and reliable discount rate, which we can use to calculate the net present value of the cash flows that we calculated. The strategy that we applied was using WACC, which is a blend of cost of equity and after-tax cost of debt to Empire. By using WACC as a discount rate, which was 8.54%, as we know based on our assumptions, we need to calculate the present value from 1999 to 2003 of the future cash flows. This amounted to 18.2 negative, 1.1 negative, 15.2, 30.8, and 1400.5 from this forecast period. This calculation was simply done by taking the cash flows and dividing them by the discount rate of WACC to come up with the present value. In 1999, as you can see, this was 19.8. Then you have to discount it by dividing it by WACC, which gave us a present value of 18.2 negative in the year of 1999. Now that we know the present value of cash flows for our 5-year forecast horizon, we need to add these numbers up, which you can see amounted to 1427.2. Although we know the present value of the assets, which amounted to 1427.2, we are not done here since we cannot forget about debt. Now the enterprise value includes company debt. As equity investors, we're interested in the value of the company's shares alone. To come up with the fair value of the company's equity, we must deduct its net debt from the value. As you can see on the screen, by minusing out the debt amount of 145.7, this gives us a present value equity of 1281.5, obviously numbers being in millions. Now the process is easy. We know that there's 38 million shares outstanding. This gives us a price per share of 33.72.
Next up is the valuation of the synergies. This valuation is a tiny bit different than the regular discounted cash flow valuation explained earlier. All the assumptions from the previous evaluation do stay, but there are some new assumptions made as well. Some of the new assumptions made are the EBITDA margin improvement assumption for the next few years. It's 0% for year 1, 0.15% for year 2, 0.25% for year 3, and is 0.5% for all subsequent years. The next assumption is the cost per year in savings for the synergy, which is total 45.6 million. This consists of 39.5 million for eliminating functions that are redundant as used in both corporations, 4.1 million in the evaluation of direct operating and warehouse wages, and 2 million in advertising. In order to have value that is conservative, the gains are assumed to be not realizable till after the first year, so 37.5% will be realizable in year 2 and 75% realizable from that point on. Also, the upfront cost of the merger is estimated at 80 million. So this discounted cash flow model is a bit different than the one previously explained. In this model, we have the EBITDA improvement of 11.8 million for year 2000 and the total synergy before tax of 17.1 million based off the 37.5 actual percentage of potential. Now we take the cost synergy estimate of 17.1 million and add it to the EBITDA improvement of 11.8 million. We then get a number of 28.9 million total synergy before tax. We take this value, we times by 1 minus 40%, which is the tax rate, to get a total synergy value after tax of 17.3 million. Now to calculate terminal value, we take 48.6, which is the future cash flows of 2003, times by 1 plus the growth rate, which is actually 0%, divided by WACC, which is 8.54%, minus 0, which is the growth rate, to get a value of 569.6. Now that we have calculated terminal value, we can calculate the present value of future synergies to get a total value of 484.90. We then minus the merger cost after tax, which as you remember were a total 80 million, times by 1 minus 40%. To get 48 million. Now after minusing out the after merger cost of 48 million, we get a present value of equity of 436.9. We divide this by the outstanding shares of 38 million to get a price per share of $11.5. Here we have a sensitivity analysis. This is a technique that is used to predict the outcome of a decision compared to different factors. Looking at this table, we can assume that when there's an increase of 1% in WACC, there will actually be a decrease in equity of 931 million, also decreasing the value per share to 24.5. And when there's a decrease of 1% in WACC, it will increase equity to 1,905.3 million and increase the value per share to $50.14. This suggests that Oshawa's common shares might currently be undervalued in the market because this analysis is most sensitive to changes in capital expenditure, with all the variables above as well.
Next is the equity financing. Equity financing is a method of raising capital by selling company stock to investors. In return for the investment, the shareholder receives ownership interest in the company. Another way to look at equity financing is a way to create money by selling off common equity, preferred stocks, convertible preferred stocks, and equity units that include common shares and warrants. When a company starts up, they usually involve numerous investors at different stages of the company's evolution. Thus, it may use different equity instruments for its financing needs. Next, I'll be going over spin-off. Spin-off is a new company that is formed by a parent company which uses parent company's assets, employees, intellectual property, and technology. Nonetheless, stakeholders may buy or sell shares from either parent or sub-company, thus making investment within the company more attractive. Potential purchasers of the shares can invest in the business in which they believe will have the most growth within. In comparison, regarding the case, Empire is a family holding company. It will be more beneficial to use a spin-off method. Otherwise, using the equity method may cause a discount to its true value. The spin-off method is recommended in this situation because it provides stakeholders with the option of exchanging all their parent company shares with the sub-company. This builds strong loyalty with stakeholders and they will be giving to stay with the company for a long time. Offer price. In this case, Empire uses spin-off method to finance a deal of acquiring Oshawa's assets. The way to do this is to evaluate the shares by using comparables such as price to earning ratios. What is per share earning ratio? Per share earning ratio is the ratio for valuing a company that measures its current share price relative to its per share earnings. Next, taking the average price to earning ratio of Oshawa Group, Empire, and its competitors, but excluding Loblaws would be 15. This 15 shares per every dollars of earning. Taking a look at Empire's net earning of 88 million, which is given in the case, taking 37% of that, which is 32.6 million, you get your Empire's earnings from food business. Now taking a look at the net earnings of Oshawa, which is 54.6 million, which is given in the case. You add that by 32.6 million and you get a total of 87.2 million, and this is the total net earning combined operations. Next, you multiply 15 by 87.2, which gives you 1.3 billion, and this is your total equity value combined operations. In conclusion, seeing that Empire desires to hold majority stake in the new company, a 60% ownership stake of Oshawa Group was assigned, which when calculated drives a 4.57.6 million in equity for financing the spin-off method.